What if the legal emergency exit button designed to instantly wipe your crushing debt clean actually triggers an invisible 10-year institutional quarantine protocol? When predatory credit card balances or aggressive wage garnishment threaten your survival, declaring legal bankruptcy feels like a magical, painless fresh start. Your cognitive wiring naturally overvalues this immediate relief, desperately craving a clean slate while completely discounting the brutal, compounding penalties waiting on the other side. But beneath the surface of this legal lifeline lies a structural irony, a system that locks you out of the modern wealth creation infrastructure entirely. To escape a financial crisis, you are forced to pay thousands of dollars in upfront cash that you theoretically do not even possess. And once that pen leaves the paper, you quietly enter a systemic isolation zone, remaining an economic ghost for the next 3,650 days. To truly understand this administrative trap, we must dissect the functional divergence between Chapter 7 liquidation and Chapter 13 restructuring timelines. The moment the court processes your petition, your consumer credit profile suffers an immediate, devastating plunge of up to 200 points instantly. Under Chapter 7, an appointed trustee systematically surveys your estate, preparing to liquidate non-exempt personal asset protections to satisfy aggressive corporate creditors. Conversely, Chapter 13 binds your future income to a punishing, court-mandated repayment blueprint that dictates every single dollar you spend for 5 years. This brings us to the upfront premium matrix, a predatory mechanism where specialized bankruptcy attorneys demand substantial flat retainers before filing a single document. They require these guaranteed cash deposits up front to insulate themselves from the very debt erasure mechanisms they aggressively promote to you. But an even more dangerous administrative trap awaits those who pursue standard debt relief programs instead of formal, court-supervised bankruptcy. This is the taxable phantom income loophole, where primary lenders report your forgiven credit balances directly to the federal government as ordinary income. Suddenly, your unsecured credit card crisis is magically transformed into a non-dischargeable federal tax obligation that cannot be legally erased by anyone. You traded a corporate collections department for the Internal Revenue Service, effectively jumping from a temporary financial pan into a permanent fire. For the next 10 years, automated underwriting algorithms across major banking institutions flag your name instantly, classifying you as high-risk dead weight. If you manage to secure capital for a vehicle or a home, you are funneled directly into subprime structures demanding 30% interest. This interest premium penalty quietly drains your liquidity, ensuring that your wealth-building engine remains completely frozen while peers advance their asset portfolios. The legal system marketed a fresh start, but what you actually received was a systemic exclusion from the primary mechanisms of capital accumulation. Consumer capitalism relies heavily on your psychological exhaustion to drive you toward these expensive, institutionalized emergency escape doors. They profit from your natural human cognitive errors, monetizing your desperate need for immediate relief while concealing the long-term wealth destruction. Breaking free from this cycle requires a fundamental upgrade of your financial intelligence and a deep understanding of unwritten systemic codes. The global financial system operates on unwritten rules, specifically designed to harvest massive profits from your temporary periods of economic desperation. If you want to decode these systemic economic matrices and upgrade your financial intelligence every single week, hit the subscribe button right now to fortify your asset engine. To grasp the astronomical reality of this 10-year financial quarantine, let us examine a rigorous simulation tracking two distinct economic profiles. Consumer A files for immediate Chapter 7 relief, experiencing an instant, intoxicating surge of phantom wealth during the very first year. Meanwhile, Consumer B completely avoids the bankruptcy trap by executing a painful lifestyle downgrade and initiating direct, aggressive negotiations with primary creditors. Fast forward exactly 5 years into the simulation, where the invisible structural mechanisms of the credit market begin to manifest. Consumer A attempts to secure a prime mortgage to purchase a suburban home, only to face immediate rejection from automated bank underwriting algorithms. Because of that lingering 10-year black mark, competitive business capital remains completely inaccessible, forcing her to rely on predatory subprime lenders. Conversely, consumer B has steadily repaired his primary credit profile, unlocking access to prime interest rates and highly competitive investment capital. When we audit the total asset velocity over a decade, consumer A suffers a staggering net loss of over $150,000 compared to consumer B. Consumer A remains trapped in a high-deposit netherworld, paying massive premium penalties on every single financial transaction she attempts to execute. This is the true hidden cost of legal debt relief. It converts a temporary cash flow crisis into a long-term capital containment field. By freezing your ability to leverage cheap capital, the system quietly strips away your prime wealth-building years, leaving you permanently behind. The legal fresh start was never a liberation. It was an administrative protocol to contain high-risk consumers while the primary market moves forward. To bypass this systemic economic matrix, you must deploy an advanced asset management life hack known as the Pre-Emptive Hardship Leverage Protocol. This highly scientific environment control skill allows you to circumvent predatory relief agencies entirely by taking direct control of the institutional narrative. Instead of declaring insolvency, you manually trigger the specific mathematical formulas primary creditors use to evaluate systemic default risks. You bypass standard frontline customer service representatives and directly contact the internal underwriting department to request a formal hardship structure. By presenting your internal risk metrics correctly, you force the institution to manually compress your compounding interest rates down to exactly 0%. This administrative maneuver freezes your interest accrual instantly, allowing every single dollar of your payments to directly reduce the primary balance. Tomorrow morning, pull your primary financial statements and locate the hidden internal hardship underwriting contact numbers skipped by standard customer service. Deploy our structured negotiation script immediately to freeze your interest accrual without destroying your critical 10-year financial horizon. By utilizing the bank's own internal underwriting guidelines against them, you protect your credit score from a catastrophic 10-year quarantine protocol. This proactive behavioral intervention ensures that you preserve your primary capital infrastructure while systematically eliminating outstanding consumer debt. True financial intelligence means refusing to accept the lazy, expensive emergency exits marketed by specialized debt collection industries. You possess the exact mathematical blueprints required to dismantle your liabilities manually while keeping your wealth-building engine fully intact. Take decisive action tomorrow morning, fortify your financial environment control, and refuse to let corporate capitalism freeze your economic future.